In December 2024, an Ontario court signed off on a $70 million settlement with one of Canada's biggest banks. And almost nobody it was about ever noticed the fee at the center of it. TD Asset Management agreed to pay $70.25 million to settle a class action. Court approved December 10th, 2024. But here's the part that matters. TD didn't admit it did anything wrong. It settled the way companies do to make a lawsuit go away without a trial. So this video isn't TD is evil, go get your money. The claim deadline for that settlement has already passed. I'll be straight with you about that. This is about the FEE the case was fighting over. Because if you've ever owned a mutual fund at a Canadian bank, there's a decent chance you paid a version of it quietly for years and never saw it leave. I'm Mike. Let me show you exactly what this fee is, whether it touched your money, and how to make sure it never does again. The fee has a boring name, a trailing commission, sometimes called a trailer fee. And boring names are exactly how expensive things hide. Here's the idea. When you buy a mutual fund, a slice of that fund's money gets paid out every year to whoever sold you the fund. The official reason? To pay for ongoing advice, someone in your corner keeping you on track. That's a fair deal. If you're actually getting advice, pay for advice, get advice. Fine. But now, watch what the lawsuit said happened. A lot of people didn't buy their TD funds from an advisor. They bought them themselves online through a discount brokerage. A discount broker is a do-it-yourself platform. By the rules regulators set, it is not allowed to give you advice. That's the whole trade. Cheaper because you're on your own. And yet the lawsuit alleged the trailing commission, the advice fee, got paid out anyway on funds people picked themselves where no advice was given or allowed. The numbers in the claim were not small. It was alleged TD paid roughly $622 million in trailing commissions to discount brokers between 2002 and 2022. Including about $522 million to a broker it was affiliated with. Again, alleged. TD never admitted that was improper. It settled. But the mechanism the case describes is real. It was legal at the time, and it ran for 20 years. So did you pay it? Here's the honest test. If you held a TD mutual fund through a discount brokerage, you bought it yourself online, no advisor, then a trailing commission was very likely baked into that fund's fee, going out of the fund's assets year after year. You'd never see it as a line item. It doesn't show up as a withdrawal. It's inside the fund's MER. It's the management expense ratio, the all-in yearly fee that gets skimmed off the top before you ever see a return. That's the genius and the frustration of it. A fee you can't feel is a fee you don't fight. Nothing leaves your checking account. The fund just quietly returns a little less than it could have. The settlement itself covered people who held TD mutual fund units through a discount broker on or before September 11th, 2024. There was even a separate, smaller settlement, $8.5 million, for people who held them another way. I have to be clear, because this is the honest part. The deadline to file a claim in that main settlement was December 20th, 2025. It has passed. If you're hearing about this now, this is not a go collect a check video. The value here is different and it's bigger. It's understanding the fee, so you stop paying it going forward. That's the money that's actually still on the table. Yours next year and every year after. Two things changed and one thing didn't. What changed? In 2022, Canada's regulators banned trailing commissions from being paid to discount brokers. Full stop. So that specific loophole, paying an advice fee on a fund you bought yourself, is closed. What did not change? Bank mutual funds still carry high fees. Take the trailing commission out, and plenty of these funds still charge you well over 2% a year all in. 2% doesn't sound like much. Over an investing lifetime, it can quietly eat a huge share of what your money would have earned. That's not opinion. That's just compounding, running in the fund company's favor instead of yours. So here's the move. and it's simpler than the industry wants it to feel. Step 1, find out what you actually hold. Every mutual fund in Canada has a short document called Fund Facts, 2 pages. The fee is printed right on it. If you don't know your fund's MER, that's the first thing to go read. Step 2, if the fee is high and you're not getting real advice for it, ask the obvious question. Why am I paying an advice price for a product I manage myself? Step 3, for a lot of people, the answer is a low-cost index fund or ETF. Same markets, a fraction of the fee. That's the whole game. You don't need to be clever. You need to be cheap. Quick honesty note before I say a single brand name. I use Wealth Simple, and if you sign up through my link, I get a referral bonus. I'm telling you that up front so you can weigh it. Now, let me also tell you where it's not the answer, because that's the part that makes the recommendation worth anything. The reason I point beginners here is simple. It makes the cheap, boring thing easy. You open a self-directed account, a TFSA, an RRSP, whatever fits, and you can buy low-fee index ETFs without a bank branch talking you into a 2% fund on your way out the door. The fees are a fraction of what a bank mutual fund charges. For someone whose whole problem was an invisible trailing commission, that's the direct fix. Now the honest downsides, because they're real. It's a newer company than a 200-year-old bank. That spooks some people. Fair enough. There's no branch you can walk into. If what you actually want is a human across a desk who knows your name, a discount platform, mine included, is not that. That's a real trade, not a marketing footnote. And self-directed means exactly what it says. Nobody's stopping you from a dumb move. The bank's expensive fund at least came with a person. Do it yourself means the discipline is yours. So the recommendation isn't banks bad, app good. It's if you were paying for advice you never got, stop. And a low-fee self-directed account is the cleanest way to stop. And if you genuinely want and use advice, pay for it with your eyes open. The crime was never the fee. It was the fee for nothing. Here's what I want you to actually do after this video. Pull up one fund you own. Find its fund facts. 2 pages, it's online in 30 seconds. Look at the MER. Then ask, am I getting advice worth that number? If the honest answer is no, you now know your next move. If you want the full breakdown, how the MER is built, how bank branches sell these funds, and every one of these settlements laid out settled versus proposed versus still just alleged. That's the main video this one comes from. It's on screen now. Watch that next. On the settlement itself, I'm not your lawyer and this isn't legal advice. If you want the official details, who was covered, how it worked, the settlement administrator's site is the only place that speaks for the settlement. Not me and not a news headline. And the standard reminder, this is education, not financial advice. Your money, your call. I'm just the guy who paid these fees for years before I understood them, so you don't have to. The fee at the center of a $70 million case was never dramatic. It was 2 pages away the whole time. Go read yours. One last thing before you go, because this is so much bigger than TD. TD was simply the first bank to settle. The first domino. Across the industry, a whole wave of these cases followed against other big banks and major fund managers, every one of them over this exact trailing commission fee on funds people bought themselves. But the details matter and they are easy to get wrong. Some of those cases have since settled. Some are only proposed and not yet approved by a court, and several are still just allegations the companies firmly deny and are fighting. So if you want the whole map, which bank settled, which is still being contested, and what it actually means for you, I lay every one of them out in the main video this one branches from. Start there. But do the 2-minute check on your own funds first. That is the part that actually puts money back in your pocket. I'm Mike. See you in the next one.